Imagine waking up tomorrow and your country's money still works, but the world no longer wants it. Oil isn't priced in it. Global trade isn't settled in it. Central banks aren't hoarding it. Investors aren't running toward it in a crisis. The US dollar still exists, but it's no longer dominant. That sounds abstract. It isn't. The dominance of the dollar is one of the most powerful invisible structures in the global economy. And if it cracked, the consequences wouldn't be symbolic, they would be mechanical. Right now, nearly 60% of global foreign exchange reserves are held in dollars. Most international trade is invoiced in dollars. Commodities from oil to wheat are priced in dollars. When banks move money across borders, the dollar is usually the bridge. This didn't happen by accident. After World War II, the US built a system. The dollar was tied to gold. Other currencies were tied to the dollar. Even after gold convertibility ended in 1971, the infrastructure remained. Trade contracts, financial markets, payment rails, deep liquid treasury markets, a military presence that reinforced trust. Trust is the key word, because the dollar's dominance is less about patriotism and more about plumbing. Here's how the system actually works. When a country exports goods, it often earns dollars. Those dollars don't just sit in a vault, they're recycled. Central banks buy US treasuries, sovereign wealth funds buy US assets, global banks hold dollar reserves to settle transactions. Corporations borrow in dollars because dollar markets are deep and liquid. It's a loop. The world uses dollars. The world reinvests dollars. That reinvestment finances US deficits. Those deficits create more treasuries. Treasuries become the collateral that underpins global finance. The dollar isn't just money, it's the foundation layer of the global collateral system. Now imagine that layer starts to erode. What would actually happen? First, demand for US treasuries would fall, not collapse overnight. Drift gradually. Central banks diversify. Trade contracts shift into euros or yuan. Commodity pricing experiments with alternatives. Less foreign demand means the US has to attract buyers another way. Higher interest rates. That's the uncomfortable math. For decades, the US has enjoyed what economists call an exorbitant privilege. It can borrow cheaply because the world needs dollar assets. If that privilege weakens, borrowing costs rise. And with over $30 trillion in federal debt, even small increases in rates compound fast. Higher rates don't just hit Washington, they hit mortgages, corporate loans, credit cards, asset prices. Because in modern finance, everything is linked to the risk-free rate, which is basically the yield on US treasuries. If treasuries become less dominant, the entire pricing system shifts. Second, global trade gets messier. Right now, a Brazilian company can trade with a South Korean company using dollars as neutral ground. If the dollar fragments into multiple competing currencies, businesses face more exchange rate risk, more hedging costs, more friction. Trade slows at the margins, not because ships stop sailing, but because finance becomes less efficient. Third, financial crises look different. Today, when panic hits, investors run into dollars. During 2008, during 2020, the dollar strengthens because it's seen as the ultimate safe asset. If dominance fades, where does panic go? Into multiple currencies? Into gold? Into digital assets? Into nothing? Fragmented safety is less stable than centralized safety. Now here's the twist. The world has been predicting the end of dollar dominance for decades. The euro was supposed to do it, then China's yuan, then crypto. Yet the dollar remains dominant for a simple reason: there is no full replacement. Europe has markets, but lacks unified fiscal power. China has scale, but strict capital controls. Crypto has ambition, but volatility. Replacing the dollar isn't about preference, it's about infrastructure, legal systems, deep bond markets, transparent institutions, military and political stability, decades of trust. That's hard to replicate. So the real risk isn't a dramatic overnight collapse, it's slow erosion. A world where the dollar is still first, but less overwhelming. where trade is split across blocks, where capital is more regional, where borrowing is slightly more expensive, where crises are less centralized but more chaotic. In that world, the US loses some privilege, but the global system loses something too: efficiency, liquidity, a single anchor. The irony is this: the dollar's dominance gives the US extraordinary power, but it also ties the US to global stability. If the dollar weakens structurally, the adjustment won't just be American, it will be systemic. And here's the unresolved question: if the dollar's dominance eventually fades, not with a crash, but with a shrug, will the world replace it with something stronger, or simply learn to live with something weaker?